Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about what investment opportunities and risks 2020 might bring. So with 2019 drawing to a close, can you actually believe it? I mean, seriously, it felt like we were just returning from the Christmas break yesterday. But anyway, just around the corner, I thought it might be good just to sort of reflect on, what I think might occur next year, but most importantly, what you can do about it from your own personal wealth accumulation perspective. I've found it best to kind of inform my opinions on markets and economies by doing a couple of things. Firstly, reading analysis, insights, and going to economic briefings. But I've always been careful not to overindulge in that amount of information. So sometimes you can go to too many briefings and end up sort of going down a bit of a rabbit hole in terms of what you think might be occurring. So it's best to sort of take in some of it and stand back and then sort of just digest it and take that holistic view. But you also should complement some of that sort of stuff with some real world observations. So, things like, and it's only sort of anecdotal evidence, but, discussions with business people in different industries, even observing retail traffic on historically busy times of the week, like Saturday morning, for example. If it's very, very quiet on a Saturday morning, potentially retail has some problems and so forth. So that's how I've formed my impression about different markets and the economy over the last 20 years, and the approach has served me relatively well. Although, there's that saying that there's two types of economists. The first type being those that don't know what's going to happen next, and the second type being those that don't know that they don't know that's what's going to happen next. In essence, forecasting is inherently difficult, and longitudinal studies have shown that most people don't get it right. It's really the chances or probability of getting it right is like a flip of a coin. But be that as it may, it's always good to at least, I guess, build your investment strategy and make your investment decisions to try and accommodate some of the risks and opportunities that might be presented in the market, but not take massive bets. That's what I'm suggesting. So that is, you might tilt, or you might, say, oh, look, I'll make this investment before this one. You could make either, and in the long term, it would work out well. But what you're trying to do is just accommodate some of those risks. And that's what I'm thinking about when I sit down and I wrote this blog, which obviously I'm podcasting today. Okay, so let's talk about, firstly, the economy and the risk of recession, because there's been a bit of press lately about potentially Australia slipping into a recession, or other developed economies, particularly the US. Now, if we focus our discussion on Australia, it's in its 28th year of uninterrupted economic expansion. So that is, GDP has grown for 28 consecutive years, which is a world record in the developed, out of all developed economies. But like all records, they've got to end someday. That said, population growth and raw materials, in particular iron ore exports, have been really big contributors to our economy over recent decades, and I just don't see that changing anytime soon. The iron ore price is high, exports are high, population growth is strong, overseas migration is strong, and all these things, really drive the economy. And unless we believe, or we change a view on those two inputs, I think, because I think they're the two major inputs, then I can't really see us. Of course, our growth is slowing and it's slower, but in terms of 2 consecutive quarters of negative growth, which is by definition a recession, I think I can't really see that happening. Of course, there's some sectors of the economy that are struggling. For example, retail sales have been flat in the year to September 2019, based on ABS data. And really, the weakness in retail sales has been really manifested in 2 categories: household goods and department store sales. So household goods are probably down because of the property market, being off the boil and having some issues over the last couple of years. So that impacts sentiment, demand. People go buy a new house. They typically go and buy some new white goods to go along with that house. And transactional volumes in the property market are down. Department store sales, obviously that's been a longer-term theme, really with online competition. Wage inflation has been low. The wage price index came in at 2.2%. Prior to early 2013, the index was typically almost always above 3%, and it peaked at 4% just prior to the GFC. So certainly wage growth is pretty benign, but that's a common trait across the globe, and might have to do with things like demographics and technology and productivity and these sorts of things. In terms of globally, the US probably deserves most of the attention given it's the biggest developed economy in the world, and also tends to impact sentiment at a global level. The Fed Reserve has been cutting interest rates this year and still probably has some way to go to sort of cut some more rates. President Trump has, called for more aggressive rate cutting. I think he wants the US dollar to devaluate, and even he's asked or pressured the Fed Reserve to start quantitative easing again, which is a way of increasing money flow into the economy. And what the central bank does is go and buy bonds so that money's going into the economy. But they're not talking about doing that yet, and obviously Trump just wants to, I guess, artificially stimulate the US economy so it keeps growing, so he gets re-elected and so forth. I think obviously the result of the interest rate cuts in the US will probably see the US dollar devalue over time. That's probably good for them and their economy. And if you're travelling to the US, as I did recently, it's good from a cost perspective as well. So on the whole, I think a recession in Australia or the US in 2020, I think it's unlikely. I think rate cuts in the US will keep stimulating that economy artificially. Does it create longer term issues? Maybe, but if we're just looking at 2020. And also, I don't think Australia will slip into a recession. But of course, I think these economies will keep growing, but maybe just at a slower rate. If we turn our attention to interest rates, interestingly, the Reserve Bank Governor made a speech on Tuesday night, that is the 26th of November 2019, and said that it's happy to cut rates and it would rather see the benchmark interest rate down to 0.25%. It's currently 0.75. Before they even consider quantitative easing. And the government said previously, look, it's now the government's time to really loosen fiscal policy and start spending and so forth. When I look at interest rates, I normally defer to Westpac's chief economist, Bill Evans, as I found him to be really consistently the most accurate over the years. That's not to say he gets every call right, but he's certainly got more right than he's got wrong. And Bill's forecasting only one interest rate cut in 2020 in the first quarter, so somewhere in that February-March. They don't meet in January. The big question, however, is even if the RBA cuts rates, will the banks pass it on? I don't think so. I think the banks will continue to do what they've done over the last couple of rate cuts, which is pass on about 0.15% to most borrowers, but pass the full cut on to interest-only investment loans to try and stimulate that sort of level or demand for housing investment loans, and also close the gap between what they're charging between principal interest and interest-only repayments. After the rate cuts are finished, I don't think there's a lot the RBA can do, and really it's up to, as I said, the Australian government to stimulate the economy. The good thing is Australia's debt levels are relatively low compared to other developed countries, and commodity prices are high, which means they've got plenty of fuel in the tank to spend a little bit more, particularly on infrastructure, which as a which isn't a bad idea for a country that has such strong population growth. In terms of property market, what will property do in 2020? Well, I've shared my view in September in regards to that. I said I believe that price growth will be good, but it won't get out of control, and mainly constrained by the tighter credit market. Certainly things have improved over recent months and weeks, even the last couple of months. Sales volumes have doubled or almost tripled really since the winter, so since sort of July-ish months in dollar value perspective. So about $500 million worth of property sold in Melbourne on average over the last couple of weekends in Melbourne. Remember, the peak is closer to $1 billion, but $500 million is still up on the 150 million that was being sold in the middle of winter. So with that, vendors' expectations change as well. People starting to think, okay, now might be the time to sell. So I think stock levels will rise in 2020, and we'll just see the confidence in the property market continue to improve. With respect to equity markets, so that is share markets, obviously the share markets over the last decade have benefited greatly from a low interest rate environment and relatively loose monetary policy, aka quantitative easing, as well as the economic expansion in the US has been pretty significant. It's into its 10th year of expansion, circa. So our valuations seem to be pretty high, particularly in the US, but to a lesser extent in Australia. And really, I think there are two markets or asset classes that represent the best value at the moment are UK and emerging markets. And I did a podcast last week on investing in emerging markets, so I'll leave that one alone. In terms of the UK, it's trading at relatively similar levels to what it was trading at in 1999. It's got a market yield, the FTSE 100's got a market yield of 4.8%. So even the dividend income is pretty strong. And its price to book ratio is very low. It's nearly half that of what the US looks like. So it looks cheap, and arguably I'd say that the market's probably factored in all of the risks associated with Brexit. So naturally you think, well, what's Brexit going to do? But there's two things. The market's probably already fully reflected that in the current prices. And then secondly, the companies that are on the FTSE 100 are global companies. British American Tobacco, HSBC, BP, these sorts of institutions are global. And they would have had the last 3 years to really prepare for what Brexit might bring as well. So I don't know what equity markets will do, and I'm certainly not going to try and guess. I mean, the level of volatility in equity markets is high, and anything could happen. But I do know that studies have shown that the starting market valuations is a reliable predictor to long-term returns. So that is, if you invest in markets while they look like good value, so they're below intrinsic value, then in the long run your returns are probably going to be good. If you invest in markets when valuations are very high, well, your upside is very limited and your long-term returns are low. So skew your investments then towards markets that represent the best value. With bond yields being low and uncertainty in regards to equity markets valuations being high, a lot more people are looking to sort of alternative asset class investments. And that could be really two sectors, commercial real estates, or what's called listed real estate investments trusts, or REITs is the acronym, or infrastructure. So both those are relatively defensive investments that generate higher levels of income. So they could be a good sort of proxy for a bond exposure, for example. But be careful because both the REITs index and the infrastructure indexes have returned about north of 12% over the last 5 years. So I think a lot of people are starting to think this way, and have pushed prices higher. So you want to be very selective about what investments you might make in that space. So what do you do with all this information? I think in simple terms, my advice is still to play the long game. which I talk about, really is number one rule in the first rule, I should say, that I address in the book Investopoly. So stick to your long-term investment strategy. Don't divert from that, jump at shadows, or try and make massive bets depending on, based on your view of what might happen next year. Play that long game, but also don't be blind to the risks and opportunities. So if you're investing, for example, in markets or asset classes that seem overvalued or risky, then certainly consider doing two things. One, underweighting your allocation. So, if your long-term allocation is 60% in the US market, for example, you might be at 50% today. And then secondly, using value-based investment strategies, still rules-based strategies, but trying to protect your downside there. Otherwise, look for markets that represent the best value. Stick to time-tested, rules-based, well-diversified, evidence-based investment strategies. So no throwing darts at a dartboard. And in the long run, this approach will pay handsome dividends. So that's it for this week. I hope that's been of interest. Of course, there's more information in the show notes and the blog on my website. And until next week, take care. Bye for now.